This is big news coming in for borrowers who take home loans on floating interest rates. Now, you will soon be able to track if your home loan interest rates are in fact moving in line with the changes in rates by the Reserve Bank of India. Now, the Reserve Bank in its credit policy meet yesterday has said that starting April 1st, 2019, home loan interest rates will be pegged to external benchmarks. What this essentially means is that the way a borrower's interest rate is now determined will become much more transparent. This move will also ensure that banks are in line with RBI rate cuts, and any benefits that come through with the rate cut get passed on to home loan borrowers. Well, those are the essentially what this entire move means. So these benchmarks earlier, the banks used to use their own cost of funds. They used to figure out their own way of determining at what rate should you as a borrower actually get these home loans. But now they will have to they will have to ensure that these rates are pegged to external benchmarks. So, for example, if the RBI repo rate is 6.5%, and that is the benchmark that the bank decides to use, so you know as a borrower that the rate that you will get your home loan at will be 6.5%. Over and above that, the bank can choose how much they want to charge depending on your credit rating as a borrower. So it could be 2%, it could be 2.5%. But essentially what this means is that whenever the Reserve Bank cuts its repo rate or hikes its repo rate, it will automatically get reflected in your home loan interest rate. Now, the negative part of this is the fact that your home loan interest rates will be slightly more volatile, because it will change every time the Reserve Bank decides to either hike the rates or cut the repo rates. But on the positive side is that every time the Reserve Bank cuts the rates, you will automatically, as a borrower, get a lower interest rate as far as your home loans are concerned. In fact, the Reserve Bank said in their meet yesterday that we've been moving towards enhancing transparency on loans. We moved from base rate to marginal cost of lending rate. Let's in fact go across to Kalpesh Ashar, Certified Financial Planner, who's joining us on the phone line. Kalpesh, thank you for joining us. If you can very simply explain to our viewers what this would really mean when these new rules now do come into effect.
Yeah, obviously this is a big welcome move what RBI has specially mentioned this time around in their policy. And I feel this is empowering the borrowers a little bit more better, and there will be a lot of transparency which was earlier missing. I think whenever a home loan issue used to come up, and there was a lot of ambiguity which the borrowers used to face. So still, I think there's a lot of time to go for it. It's in April will it come to effect. But I think linking it to the external benchmarks will have a lot of transparency, and especially the floating rate type of borrowers will tend to benefit from this a lot.
So, Kalpesh, of course, the rules will still need to be outlined by the Reserve Bank, as they've said that by end of December is when they will come out with the entire detailed the contours of this entire move. But prima facie, do you believe also just that there could be a possible negative side, that your interest rates will then now become more volatile?
Yeah, that we will always be exposed to that, but I think it is a much more a welcome move where at least the aware borrowers, I would say aware people who keep their eyes and ears open about what's happening, will not be at the mercy of the banks completely. So obviously we are exposed to that risk about the volatility, what you said rightly, but I think that's what's happening everywhere, and I think we should not be left behind in that for sure.
So in terms of what clarity still needs to come in from the Reserve Bank on how this will actually be implemented and how this would actually work, if you can take us through what would now you be looking for from the Reserve Bank to see how this would work?
So obviously there are 3-4 benchmarks which they will have to highlight: the Treasury bill, the GSEC yields, all those things against which are they benchmarking. And we have even the small saving schemes which are set quarterly by the interest rates are set quarterly by the RBI. we'll then have to keep a more thorough check on which is the actual benchmark being used. I think that is of prime importance, and that should be, I think, filtered out and told to the investors, the borrowers from time to time. So that is of prime importance. Which benchmark are they going to use? And I think it should be, advertised a lot in time to come. So every borrower, right from the smallest borrower to the largest borrower of home loans, is aware of it, what he is getting into.
Right. So Kalpesh, now if, as far as the entire transparency angle is concerned for borrowers, so if a bank, for example, chooses the RBI repo rate as their benchmark and then on that they decide to put a spread of 2%, if you can explain the fact that that spread itself is not going to be changed unless one's credit rating changes. So one's credit rating then becomes much more important now.
Yeah, obviously the credit rating does become important, and the banks will still have the leeway or the approval to have their margin on top of the repo rate, like what you are mentioning, if that is considered to be the benchmark. So I feel the banks now should be more transparent and more flexible in offering that as soon as these rates are announced on a quarterly basis or whenever the policy is declared.
I'm also being joined on the phone line by Karthik Jhaveri as well. Thank you, Karthik, for joining us. Your perspective on this move by the Reserve Bank, because every time, usually when we see any kind of a rate hike by the Reserve Bank, banks are very quick to implement it in terms of the kind of rates they offer borrowers. But whenever we see a rate cut, it's usually that transmission doesn't happen that fast. But now this move will put an end to all of that and ensure that all borrowers do get the benefit of any falling rates.
Absolutely, because there has always been this little bit of a pain point that you don't really know exactly how the bank is working it out. With MCLR, it was supposed to have become better, but then the bank went around telling the regulator that, look, how do I really charge and how do I really stop pricing on my loan, so to say. So which is why it started becoming opaque and like a customer disgruntlement again. So I think with this new system, it's very easy. A customer knows that he's paying a 1%, 2%, 3%, whatever is the spread. They say it is 3%. So he knows very clearly if the repo is 6, then I have to pay 3% more. If his spread is 2%, then I have to pay 6 plus 2. It's extremely easy for the customer to understand, to see what interest he is paying. For the banks, basically, there is no ambiguity in what they have to charge. So I think it seems like a great move, and obviously it will eliminate all the opacities that has been here and lurking in the past.
Right. So, of course, Karthik, we still have to wait for the final contours and final details from the Reserve Bank. But anything that you can tell us as to, of course, this will apply immediately to new borrowers. But as far as existing borrowers, we still need to see how they would have to be put onto these new rules as well.
So it's always the case, right? The existing borrowers have already borrowed the funds, and they have borrowed against some funds that were raised by the bank or the lending institution, NBFC, as case may be.
Right.
So in that case, there is already a cost structure and there is already a spread there. So always it happens that when the repricing is done or when a movement has to be done, maybe the customer will have to pay a certain amount of movement fee, could be a quarter, could be a 0.5%, and then get into the benefit. But by far, being in this floating rate scenario, for all the people who are getting into this, it's always a good idea. In fact, right now, some banks have started also promoting a fixed rate for 2-3 years, and which is a very attractive rate, and then floating. Even that's a great idea. And then that floating, which will be linked to a repo or a 91-day treasury bill, will actually be greatly in the interest of the consumer, I think.
Right. So, Karthik, we've always known that floating rates are always more beneficial than a fixed rate overall. But do you think now this becomes all the more important for consumers to realize that you have to now always opt for a floating rate whenever you're taking a loan?
Yes, that's true. For the last few years, consumers have actually learned that it's always better to be in a floating rate. But the problem was that they didn't know. They knew their spread, but they didn't know exactly what the bank is charging them, whether it's good or bad, whether the rate has got changed and the consumers have got that benefit or not got that benefit. Those were things which were an issue. MCLR reset a lot of banks. Well, majority of them were doing it on a half-yearly or a yearly basis, which also in some sense defeats the purpose. You really want to have an absolute floating rate. So in 1 month, if the 91-day T-bill goes down, give me the benefit. If it goes up, well, I'm happy to pay the price. That kind of a scenario is a really open, competitive, and a very healthy scenario to be in.
Right. So you think the fact that home loan rates will in fact become more volatile, I mean, there will be much quicker movement as and when the RBI, of course, hikes or cuts rate, that would be slightly a negative for this kind of these kind of rules?
Well, see, it would be a negative if we were a Brazil or an Argentina kind of economy. But because we are India and because we are on a growth trajectory, whether the growth happens of 7% or 6%, but we are growing, we are moving forward, and we are becoming only stronger by the day. So in that kind of a background, and that kind of a backdrop, I think it's a great advantage because we stand to benefit more than lose more. There will be interim periods of maybe quarters or even for that matter a few months, where we'll have rate spikes happening or height increases happening. But generally speaking, if a country has to progress, the rates have to be lower and softer. So with that pre-assumption, I think we are in for better times with this kind of a policy measure.
All right. We'll leave it there. Thanks, Karthik and Kalpesh, for joining us with your perspective and explaining what this really means for home loan borrowers.